Imagine a boy in Omaha, Nebraska, standing on the porch of his childhood home, flipping through pages of the stock market reports as if they were adventure novels. He wasn't chasing dragons or buried treasure. He was chasing numbers, patterns, and the invisible logic of wealth. How does a child with a paper route become the man who would one day be called the Oracle of Omaha? Warren Buffett is not just a billionaire. He is a paradox, a man who built one of the world's greatest fortunes not by rushing but by waiting, not by chasing trends but by letting time itself work as his greatest partner. In a world addicted to speed, Buffett found power in slowness. But behind the legend lies a deeper question. Was his empire built purely on financial genius? Or on something more profound, something almost philosophical about human behavior, risk, and patience? This is not just the story of a man, but of a philosophy that reshaped global finance. Today, we will step inside that journey from a young boy's fascination with numbers to a company that would become one of the most influential conglomerates in history. From moments of crisis to moments of triumph, from doubt to dominance, this is the story of Warren Buffett and Berkshire Hathaway. A story not just about business, but about the art of time, the power of discipline, and the enduring question: what does it truly mean to be wealthy? Warren Edward Buffett was born in 1930 in Omaha, Nebraska, at the dawn of the Great Depression. His childhood unfolded against a backdrop of breadlines, bankruptcies, and shattered dreams. While other children dreamed of becoming athletes or pilots, Warren's world revolved around numbers, ledgers, and the quiet hum of commerce. By the age of 6, he was already selling chewing gum door to door, learning the language of profit and loss in the most humble of ways. The boy's fascination with money was not greed, it was curiosity, an attempt to decode how value moved through society. The America of Buffett's youth was scarred by economic collapse, yet also ripe with hidden opportunity. The stock market crash of 1929 had destroyed fortunes overnight and left an entire generation wary of risk. Banks failed, industries contracted, and families clung to survival. But for the young Buffett, these conditions became a living classroom. He observed not only the fragility of wealth, but also the resilience of those who adapted. In the ruins of the old economy, he began to sense a principle that would define his life: that value often hides where fear blinds others. By the age of 11, Buffett made his first stock purchase: 3 shares of Citi Service Preferred at $38 each. He watched the price fall to $27, then rise again to $40, selling too early and missing the surge that followed. The lesson was seared into him: impatience costs more than failure. This early experiment in the markets was less about profit and more about philosophy. He realized that wealth was not a lottery ticket, but a discipline. The market, he thought, was not a place to gamble, but a place to test character. His father, Howard Buffett, a stockbroker and later a congressman, played a pivotal role in shaping Warren's values. Howard's unwavering integrity, conservative approach to money, and belief in personal responsibility left an indelible mark on his son. Warren grew up in a household where frugality was not just a necessity, but a principle. This moral backbone would become the silent engine of his empire, a refusal to be swayed by glamour and a commitment to building slowly, honestly, and deliberately. While most of his peers chased careers that promised prestige, Buffett's ambition was deceptively simple. He wanted to understand the rules of wealth so completely that he could bend them without breaking. He devoured books on business and investing, especially Benjamin Graham's The Intelligent Investor, which would later shape his entire strategy. To Warren, finance was not just numbers on a page. It was human behavior written in code, waiting to be deciphered. The conditions of mid-20th century America provided the perfect soil for this curiosity to grow. Industrial giants were rising, consumer culture was taking shape, and yet the scars of the Depression left investors cautious and conservative. It was in this environment that Buffett saw opportunity. If others were too afraid to invest, he could buy companies at prices far below their true worth. To him, markets were not chaotic, they were emotional, and where emotion ruled, reason could profit. Thus, even before founding Berkshire Hathaway, Buffett's long-term vision was clear: to build an empire not on speculation, but on patience, not on short-term wins, but on the compounding of small, wise choices made consistently over decades. In a world that celebrated the flashy and the immediate, he dreamed of building something invisible, yet unstoppable, an empire of time. Warren Buffett's journey, though often mythologized as seamless brilliance, was in truth paved with struggle. His early partnerships in the 1950s were modest, uncertain experiments rather than empires in the making. He raised small sums from friends and family, managing other people's money with more responsibility than resources. In these early years, every mistake felt amplified, every misjudgment, a threat not only to capital, but to his credibility. The boy who once dreamed of decoding the market was now accountable to real people with real fears about loss. One of his earliest brushes with failure came from his investment in Berkshire Hathaway itself, then It got a failing textile company in New England. Buffett saw an undervalued asset and bought in, expecting a turnaround that never came. The mills were inefficient, foreign competition was rising, and the industry was in decline. For years, Berkshire drained his capital, teaching him a painful truth. Not every cheap company was a bargain. This was not just a financial setback, it was a philosophical one. He had trusted numbers without fully weighing the tides of industry. The pressure to perform was immense. Buffett's style of investing, slow, methodical, and focused on value, often looked foolish in times of market exuberance. While others chased quick profits and fashionable stocks, Buffett refused. There were moments when he questioned himself. Moments when his returns lagged behind the broader market. Moments when investors doubted his patience. The temptation to abandon his principles and play the game like others loomed large, yet each time he resisted. He understood that chasing the crowd was the fastest route to mediocrity. His turning point came through humility, by admitting that Berkshire, as a textile business, would never thrive, but as a holding company it could. Buffett slowly pivoted Berkshire from a struggling mill into a vehicle for acquisitions and investments. This was not a single bold move, but a series of small, deliberate steps. He began buying insurance companies, banks, and consumer brands, recognizing that Berkshire's shell could become the skeleton of something far greater. The pivot was not glamorous, but it was revolutionary. There were also lessons and personal setbacks. Buffett's frugality sometimes made him miss opportunities others took boldly. At times, he regretted not moving faster or larger into investments he believed in, such as certain early stakes in tech-related industries. These near misses haunted him, but they also refined his sense of discipline. Never invest outside your circle of competence. But within it, act with conviction. Mistakes, he realized, were inevitable. What mattered was not avoiding them entirely, but ensuring they never destroyed the foundation. Through these years of tension, Buffett also learned the importance of temperament over intelligence. The market, he discovered, was less about brilliance and more about endurance, the ability to stay rational when others panicked. The lesson from his failures was not, don't make mistakes, but survive your mistakes. This philosophy became his compass. Always protect against permanent loss of capital, even if it meant sacrificing short-term gains. By the time his pivot was complete, Buffett was no longer just an investor, he was a strategist. He had learned that businesses were not abstract numbers on paper, but living organisms shaped by industry trends, human behavior, and leadership quality. His early struggles forged the discipline and humility that would define his empire. In the ashes of missteps, he built a method that would outlast fads, crises, and even his own lifetime. Warren Buffett's momentum did not begin with a grand, decisive stroke, but with a series of patient, calculated moves. His early partnerships in the 1950s and 1960s laid the groundwork, teaching him the power of compounding, not only in capital, but in trust. Investors who placed their faith in him found that their money grew steadily, without the reckless swings of speculative markets. This consistency became Buffett's first true innovation. In a world obsessed with speed, he showed that slow growth could be far more powerful. The acquisition of Berkshire Hathaway, though initially a mistake, became the cornerstone of his transformation. What began as a failing textile business turned into an unlikely vessel for opportunity. Buffett realized that instead of reviving the mills, he could redirect the company's cash flows into better ventures. This was a radical shift in thinking. Berkshire was no longer a textile firm. It was a platform, a holding company with the flexibility to own pieces of businesses across industries. In that pivot, a dying factory became the seed of an empire. One of his most iconic early moves was entering the insurance business, particularly through the purchase of National Indemnity in 1967. Insurance offered something unique: a steady stream of cash, known as float, which Buffett could invest long before claims were paid. This insight was a turning point. Instead of relying solely on profits from operations, Berkshire now had access to a permanent engine of capital. It was a strategic breakthrough that would power decades of investments, from Coca-Cola to Apple. Strategic partnerships also shaped this era. Buffett's collaboration with Charlie Munger was perhaps the most important of all. Munger urged him to think beyond mere bargains and instead focus on businesses with durable competitive advantages, companies with strong brands, loyal customers, and enduring moats. This adjustment in philosophy sharpened Buffett's approach. He would no longer buy companies simply because they were cheap. He would buy them because they were great, even if the price was higher. This shift elevated Berkshire from a bargain-hunting fund to a curator of enduring businesses. Momentum grew as Berkshire acquired household names like See's Candies and The Washington Post. These investments were not just profitable, they revealed the elegance of Buffett's approach. A small candy company became a compounding machine. Newspaper became a symbol of credibility and influence. Each acquisition told a story not of conquering, but of stewardship. Buffett didn't merely buy businesses, he nurtured them, letting management thrive rather than interfering with day-to-day operations. Over time, Berkshire became something more than a corporate entity. It became a philosophy embodied in every shareholder letter and every quiet decision. Buffett's discipline, his aversion to speculation, his devotion to long-term value, these were not strategies alone, but principles. Berkshire represented an alternative to Wall Street's frenzy, a reminder that capitalism could be patient, rational, and humane. In the world of business, Berkshire was not just a company, it was an idea made visible. This philosophy began to attract not only investors, but disciples. Shareholders didn't just buy stock, they joined a worldview. The annual Berkshire meetings became pilgrimages, where tens of thousands gathered not only to hear about profits, but to learn about life, decision-making, and responsibility. The textile mill that once symbolized decline had been reborn as a cathedral of patience. What Buffett and Munger built was not just momentum, but a movement. As Berkshire Hathaway moved into the 1970s and beyond, the quiet foundation Buffett had built began to expand into something monumental. What once started with modest partnerships and a faltering textile mill evolved into a conglomerate of extraordinary breadth. Berkshire's acquisitions stretched across industries: insurance, media, railroads, utilities, consumer goods. Each purchase seemed unglamorous on the surface, but within it lay the brilliance of Buffett's philosophy. He wasn't buying companies for excitement. He was buying streams of reliable cash that could endure for decades. The scale of Berkshire's acquisitions was staggering, yet what made them remarkable was not size, but philosophy. Buffett's approach to value investing, buying businesses for less than their intrinsic worth, remained unchanged. Even as the numbers grew larger, he applied the same logic to a billion-dollar deal as he did to a stock worth a few dollars. In a financial world where growth often dilutes discipline, Berkshire proved that scale did not have to mean compromise. Among the iconic acquisitions was Geico, the insurance company that had once fascinated Buffett as a young man. In buying Geico, he wasn't simply purchasing a business, he was fulfilling a decades-long conviction. Geico embodied everything Buffett loved: simplicity, durability, and a model that generated vast amounts of investable float. Similarly, his stake in Coca-Cola in the late 1980s revealed his gift for recognizing global brands with timeless appeal. These investments became not just financial wins, but cultural landmarks in the story of Berkshire. Yet expansion was never without risk. Every acquisition was a bet not on markets, but on human judgment. Buffett placed immense trust in the managers of the companies he acquired, often leaving them to run their businesses with minimal interference. This hands-off approach could have backfired, but instead, it created a culture of stewardship. Berkshire was not a controlling overlord, but a guardian of autonomy. The risk of decentralization became a strength as great leaders thrived under Buffett's umbrella. Of course, risks were not always rewarded. Berkshire occasionally faced criticism for deals that seemed too conservative or at times too bold. Some acquisitions underperformed, others tied up vast amounts of capital that might have been more profitable elsewhere. Yet Buffett's genius lay in resilience. He diversified Berkshire's portfolio so broadly that no single misstep could break the system. The empire was built not on perfection but on anti-fragility, the ability to absorb shocks and grow stronger from them. As the empire expanded, so did the responsibility. Buffett was no longer managing just investments. He was managing trust at a global scale. Investors around the world looked to Berkshire as a safe harbor, and with that came immense pressure. A mistake at Berkshire wasn't merely financially, risked tarnishing a philosophy. And yet, Buffett accepted this burden with unusual calm, reminding shareholders that risk was not to be feared, but to be understood and endured. By embracing risks with patience and by scaling without abandoning principle, Buffett turned Berkshire Hathaway into a paradox, a giant that moved slowly, a conglomerate that grew by resisting haste. It was proof that in business, growth is not merely about expansion, it is about endurance. In every risk taken and every acquisition made, Buffett's empire was not only scaling in size, but deepening in resilience. The lesson was clear. Scale magnifies both mistakes and wisdom, and only discipline decides which one prevails. Every empire, no matter how carefully built, must endure storms. For Warren Buffett and Berkshire Hathaway, those storms came in the form of market crashes, public controversies, and the harsh reality of managing a sprawling conglomerate. The myth of the Oracle of Omaha was never that he avoided crises, it was that he faced them with a discipline rare in the world of finance. Through each test, Buffett revealed that resilience, not brilliance, is the true currency of survival. This is one of the most notable controversies erupted in the early 1990s, when Salomon Brothers, a firm in which Berkshire had invested heavily, was caught in a scandal involving illegal treasury bond trading. Buffett, thrust into the role of interim chairman, had to navigate a firestorm of regulatory scrutiny and public outrage. The incident threatened not only the reputation of Salomon but also Buffett's credibility, yet he responded with his trademark candor, admitting mistakes, enforcing accountability, and restoring trust through transparency. It was a harsh reminder that even Buffett's empire was vulnerable to human failure. Market crashes tested him in different ways. During the dot-com bubble of the late 1990s, Buffett was ridiculed for avoiding technology stocks. Analysts claimed he was out of touch, too old-fashioned to understand the future. Yet when the bubble burst in 2000, wiping out billions, Buffett's discipline was vindicated. Later, during the 2008 financial crisis, he once again demonstrated his contrarian courage, investing billions in companies like Goldman Sachs and Bank of America at the height of panic. Where others saw collapse, Buffett saw opportunity. But crises also exposed Berkshire's limits. Not every move during downturns was perfect, and some investments suffered alongside the broader market. Buffett's strategy, however, was never about escaping loss altogether. Instead, it was about positioning Berkshire to endure short-term pain for long-term resilience. He reminded shareholders that volatility was not risk, permanent loss of capital was. This distinction, simple yet profound, became a mantra for survival. Public perception was another battlefield. Buffett cultivated an image of modesty and frugality. But critics often pointed to the immense wealth he accumulated, questioning the morality of billionaires. His response was not defensive. Instead, he pledged to donate nearly all his fortune to philanthropy, framing wealth as a responsibility rather than a prize. This decision reframed his legacy not as a hoarder of capital, but as a steward of it, intent on redistributing its power. Internally, managing such a vast web of businesses carried its own controversies. Decentralization worked wonders in empowering leaders, but it also created blind spots. Mistakes at subsidiary companies sometimes caught Buffett by surprise, reminding him that no system, however elegant, was immune to error. His response was rarely to tighten control, but to reinforce culture, trust, honesty. Accountability remained the anchors of Berkshire's internal compass. Through scandals, crashes, and criticism, Buffett's lesson was consistent. Survival is not about perfection, but about principle. He showed that transparency builds credibility, patience turns crises into opportunities, and discipline protects against ruin. Crises did not weaken Berkshire Hathaway. They hardened it. Each controversy left scars, but also wisdom. And in those scars, investors and entrepreneurs alike found the clearest reflection of Buffett's enduring truth: that business is not the absence of failure, but the art of outlasting it. Adapting in the age of AI tech and shifting markets as the 21st century unfolded, the world entered a new era where artificial intelligence, digital platforms, and rapid technological disruption reshaped industries almost overnight. For decades, Berkshire Hathaway had been known for its deliberate avoidance of high-risk, speculative ventures in cutting-edge technology. Buffett himself often admitted he didn't understand tech well enough to invest in it. Yet even the Oracle of Omaha could not ignore the changing tides. The 2016 stake in Apple marked a turning point. It was more than just a bet on a company. It was a recognition that consumer technology had become a fundamental utility of modern life. Berkshire's portfolio, once dominated by insurance, energy, and consumer goods, began to reflect a cautious but undeniable pivot toward relevance in the digital economy. The challenge, however, wasn't just about investments. Berkshire had to balance its long-standing identity as a fortress of stability with the demands of a market driven by speed, algorithms, and constant innovation. Could a conglomerate built on timeless patience remain competitive in a world that rewarded rapid iteration and disruption? Berkshire's answer wasn't to compete head-to-head with Silicon Valley, but rather to selectively embrace technology, where it aligned with its philosophy of durability, scale, and consumer trust. Leadership today: Buffett, Munger, and succession planning. By the late 2010s and into the 2020s, an unavoidable question loomed larger each year. What happens when Buffett and Munger are no longer at the helm? The duo had led Berkshire for over half a century, shaping it into one of the most admired corporations on earth. But with both men entering their 90s, succession was not just a theoretical concern, it was an urgent necessity. Buffett himself often reassured shareholders, "We've got the right people in place." Names like Greg Abel and Ajit Jain rose to prominence, embodying the future leadership structure of Berkshire. Still, for many, the real challenge lay in cultural continuity. Berkshire Hathaway was more than its assets. It was a philosophy, a way of thinking about capital, responsibility, and the long game. Would future leaders maintain that ethos? Or would the conglomerate be pressured to modernize in ways that diluted its identity? Investors, employees, and the broader financial community watched closely as Berkshire carefully choreographed its transition from legendary leadership to the next generation. Is Berkshire Hathaway still relevant in the 21st century? The question of relevance has become one of the most persistent debates surrounding Berkshire Hathaway in the modern era. On one hand, critics argue that the company has become too large, too slow, too conservative to capture the explosive growth of emerging industries. In an age dominated by companies like Tesla, Amazon, and Nvidia, Berkshire's holdings in railroads, insurance, and energy might seem outdated. On the other hand, supporters point to Berkshire's resilience, its fortress-like balance sheet, and its unique ability to thrive in downturns. In a world often obsessed with speed, Berkshire's patience remains a competitive advantage in itself. Perhaps the truest measure of relevance lies not in whether Berkshire keeps pace with every technological fad, but whether it continues to embody principles that withstand the test of time. Rationality, discipline, trust, and adaptability. In that sense, Berkshire Hathaway may not only remain relevant in the 21st century, it may prove to be one of the few corporate giants that can bridge the gap between old-world investing wisdom and the demands of a rapidly transforming economy. Warren Buffett's career has been studied, quoted, and imitated more than perhaps any other investor in history, yet his guiding principles are strikingly simple. Know what you own. Be patient. Focus on value, not hype. Avoid debt when possible. Build trust that compounds faster than money. For entrepreneurs, these aren't just financial strategies. They are survival tools. Buffett's emphasis on integrity, reputation, and clarity of thought reminds us that in a noisy marketplace, discipline and consistency remain rare advantages. Equally important is the idea that business should serve a purpose greater than profit. Buffett often points out that money is only a byproduct of solving real problems and serving customers well. This orientation toward value creation rather than short-term wins has helped Berkshire cultivate companies that endure across generations. Entrepreneurs today, whether in Silicon Valley or a small-town workshop, can draw from the same well. Durability beats velocity, and trust beats opportunism. Mistakes and lessons from Buffett's philosophy. Buffett himself has never shied away from admitting mistakes. He famously called his purchase of Dexter Shoe one of the worst decisions of his life, a deal paid with Berkshire stock that would later be worth tens of billions. His reluctance to invest in technology for decades caused Berkshire to miss out on the early rise of companies like Microsoft, Amazon, and Google. Yet these missteps are perhaps more valuable than the triumphs, because they showcase his humility and adaptability. The key to being successful, Buffett once said, is not how often you're right, but how well you learn when you're wrong. The lesson is that mistakes are inevitable, even for the most disciplined minds. What matters is the ability to acknowledge them, adjust course, and ensure they don't threaten the survival of the business. Buffett's philosophy teaches that protecting the downside is more important than chasing every upside. Entrepreneurs can learn to balance ambition with caution, daring with restraint. By embracing the humility to be wrong and the wisdom to pivot, the future, will Berkshire endure another decade? As Buffett and Munger's era inevitably comes to a close, the question remains, will Berkshire Hathaway still thrive in the decades ahead? On a purely financial level, the company's fortress balance sheet, its diversified businesses, and world-class managers suggest that it will. Berkshire's decentralized structure has always been designed to outlast its leaders, empowering subsidiary CEOs to run their companies with autonomy. In many ways, Berkshire's resilience is already hardwired, yet the future is about more than numbers. Berkshire's true legacy will depend on whether its culture, its ethos of patience, rationality, and integrity, can survive in a world driven by speed, speculation, and short-termism. If future leaders resist the temptation to modernize at the expense of principle, Berkshire could remain a beacon of financial stewardship well into the mid-21st century. If not, it risks becoming a monument to what once was. Ultimately, perhaps the greatest lesson of Buffett's story is this: success isn't about brilliance in the moment, but about building systems, cultures, and reputations that endure long after individuals are gone. Whether Berkshire thrives another decade or another century, its impact on business thinking is already immortal. So what is wealth, really? Is it the billions in a bank account? Or is it the quiet discipline to wait when the world demands haste? Warren Buffett's journey suggests that true wealth is less about numbers and more about perspective. Perhaps it lies in patience, in the compounding of trust, in the courage to think long when others live short. And yet, the question remains. In a century obsessed with speed and disruption, can patience still be the ultimate advantage? Or will the next Warren Buffett redefine what it means to invest in time itself? If this story moved you, imagine what other lessons history's greatest business minds still hold. Subscribe and join us on this journey into the strategies, struggles, and philosophies that shape the world's biggest empires. Because the next idea that inspires you might just be the beginning of your own.